Hello, I'm Yutaka Watanabe, a tax accountant. Welcome to the Tax Accountant Nabe Solves Your Money Problems channel. Today, I'd like to talk about the topic, is there only one tax treaty? If you are involved in international business, you have probably come across tax treaties at some point. However, surprisingly, few people truly understand their real nature and legal character. And this misunderstanding can sometimes lead to unexpected cost or unnecessary trouble. So today, let's clear up that misunderstanding once and for all. Let me ask you a question. When you hear the term tax treaty, what image comes to mind? Do you imagine one chic universal rulebook used all over the world? That is actually a very common misconception. So, let's begin by clearing up that myth. Tax treaties are one giant global rulebook. That idea is completely wrong. Tax treaties are not universal. Rules apply worldwide. This is the most important point. A tax treaty is always an agreement made between two countries individually. Whether or not you understand that premise can significantly affect how you approach international business. So, what does that really mean? Let's dig deeper into the key word. Bilateral agreement. Understanding this is the first and perhaps biggest step toward mastering international taxation. A tax treaty is essentially a special agreement between two specific countries. Its two major purposes are: first, preventing double taxation on the same income. Second, preventing tax avoidance. And most importantly, these rules only apply in a one-to-one bilateral relationships. Let's look at concrete evidence. You may hear each treaty is different, but that may not fully register until you see examples. Take Japan. Japan had the Japan-U.S. tax treaty with the United States. Japan also has the Japan-China tax treaty with China. The name may sound similar, but the contents are certainly different. You cannot apply the Japan-U.S. treaty rules to China, and vice versa. Each treaty only has effect between two countries that sign it. That is a critical limitation. Moreover, even bilateral treaties can differ significantly depending on when they were signed and the negotiation history behind them. For example, consider withholding tax rates. Dividend, interest, and royalty rates can all vary by treaty. One treaty may provide an exemption. Another may impose 10%. Another may impose 15%. They can all different. Definition of permanent establishment, as well as limitation on benefits provisions can also vary substantially. Thinking this is probably the same as my previous case can lead to unexpected underpayment or overpayment of tax. That is why it is essential to develop a habit of checking each treaty carefully, which leads to the most important practical point. Review each treaty individually. What is standard in the United States may not apply in China at all. It sounds obvious, but it is significantly easy to overlook. Always keep that in mind. Now, after discussing all this, let's get to the conclusion. How does this affect your business? Here are 3 steps to remember whenever engaging in international transactions. Step 1. Identify the country you are dealing with. That is the foundation. Step 2. Find the specific tax treaty between your country and that country. Step 3. Understand the unique rules contained in that treaty. This process is the most reliable way to avoid unnecessary risks and unexpected costs. Why is this extra effort so important? 3 reasons. First, it prevents dangerous assumptions like it worked this way in the US, so it should work the same here. Second, it helps avoid unexpected double taxation. Third, it allows you to make business decisions based on accurate information while staying legally compliant. And that matters greatly for long-term trust and cost management. If there is one takeaway from today, it is this. Never rely on assumptions, even if it feels inconvenient. Always check the specific treaty with the country you are dealing with. That simple habit can protect you from major problems in the future. And let me leave you with one question. For the business or investments you are involved in today, do you truly understand the tax treaty with the country you are dealing with? I hope today's discussion gives you a good reason to review that. Today, I talked about the topic. Is there only one tax treaty? For more on international taxation, please also visit the website of Yutaka Watanabe, Tax Accountant Office. I'll continue sharing insights on money-related topics, so please subscribe to the Tax Accountant Nabe Solves Your Money Problems channel.